Welcome and thank you for being here today. I am excited because we are going to talk about something that could really level up your trading skills. Today we are diving into how to use the moving average exponential indicator, known as the exponential moving average, to help you in your trading. By the end of our time together, you will know how to use this tool to spot trends, identify buy and sell signals, and sharpen your overall strategy. Stick around because I promise you will walk away feeling more confident in using this indicator. Imagine having a tool that allows you to see the market's movements almost as if you had a crystal ball, giving you a clear picture of where the price is likely heading. That is exactly what the exponential moving average can offer. Let us start by talking about what the exponential moving average is and why it is important for traders like you. The exponential moving average is a technical indicator that helps make sense of price movements by smoothing out all that noisy data. Unlike a simple average, the exponential moving average gives more weight to recent prices, which means it can react more quickly to changes in the market. This is a big deal because you want to catch those shifts early. Whether you are a short-term trader looking to react quickly or a long-term trader who wants to see momentum shifts clearly, this is a tool that can help. To make the most out of the exponential moving average, it is also useful to understand some common chart patterns that appear alongside it. These patterns can provide more context and help confirm the signals you get from the exponential moving average. For example, you may come across head and shoulders patterns, double tops or double bottoms, and flags or pennants when using the exponential moving average. A head and shoulders pattern, for instance, is a reversal pattern that can indicate a change in trend direction. When this pattern forms and the price crosses below the exponential moving average, it strengthens the signal that the trend may be reversing. Another common pattern is the double top or double bottom. A double top happens when the price reaches a high point twice and fails to break through, while a double bottom is when the price hits a low point twice. When these patterns occur near an exponential moving average, they can give you more confidence in whether a reversal is about to happen. If a double top forms and the price then moves below the exponential moving average, it is often a signal that the trend will continue downwards. Flags and pennants are continuation patterns that often occur after a strong price movement. When these patterns form, the price tends to consolidate before continuing in the direction of the original trend. If a bullish flag forms and the price stays above the exponential moving average, it is usually a strong signal that the uptrend will resume. These patterns, when used in conjunction with the exponential moving average, help you better understand the overall market context and give you additional confirmation before making a trade. By learning to recognize these chart patterns and seeing how they interact with the exponential moving average, you can make more informed decisions and improve your accuracy in predicting market movements. Think about it like this. If you are sailing a boat, you want to know if the wind is changing direction as soon as possible, not after it has already blown you off course. The exponential moving average helps you sense those changes early, and that gives you an edge. Now let us talk about how to set up this tool. You can adjust the time period of the exponential moving average to match your trading style. If you are someone who trades more frequently, you might go for a 12-day or 26-day exponential moving average. These time frames are popular for short-term traders because they react more quickly to price changes. On the other hand, if you are a long-term trader, you may want to use a 50-day or even a 200-day exponential moving average. This way, you are focusing on bigger trends that last longer. It is all about making sure you are looking at what matters most for your style. In addition to adjusting the time period of the exponential moving average, you should also pay attention to how different chart patterns can influence your trading decisions. Recognizing chart patterns such as head and shoulders, double tops and bottoms, flags, pennants, wedges, triangles, cup and handle, and rectangles can provide deeper insights into potential trend shifts or continuations. Each pattern offers valuable clues about market sentiment and can help you decide when to enter or exit a trade. For example, the head and shoulders pattern is a reversal formation that signals a shift from bullish to bearish trends. It consists of a peak shoulder, a higher peak head, and then another lower peak shoulder. When the price breaks below the neckline, which is a support line drawn beneath the pattern, it indicates a bearish reversal. In contrast, an inverse head and shoulders pattern indicates a bullish reversal, where the price is likely to rise after breaking above the neckline. Double tops and double bottoms are also essential to understand. A double top indicates that the price has tested a resistance level twice and failed to break through, signaling a potential bearish reversal. Conversely, a double bottom forms when the price hits a support level twice and bounces upwards, suggesting a bullish reversal. Flags and pennants are typically continuation patterns. Flags form after a sharp price movement, followed by a brief period of consolidation in a rectangular shape, while pennants form in a small symmetrical triangle. Both patterns indicate that the market is taking a breather before continuing in the direction of the previous trend. When these patterns form above or below an exponential moving average, they can provide a stronger signal of trend continuation. Wedges are particularly interesting patterns that can either be reversal or continuation signals depending on their context. Rising wedges tend to form during uptrends and indicate a potential bearish reversal as momentum begins to weaken. Falling wedges, on the other hand, appear in downtrends and often signal a potential bullish reversal. The interaction between the wedge pattern and the exponential moving average can help you determine whether the price is likely to break out or reverse. Triangles are versatile patterns with ascending, descending, and symmetrical variations. Ascending triangles typically occur in an uptrend and signal a potential breakout when the price reaches the horizontal resistance line. Descending triangles indicate bearish sentiment as price forms lower highs and approaches a support level that eventually gives way. Symmetrical triangles can be neutral with breakouts possible in either direction, and the exponential moving average can help provide additional clues on the likely direction. The cup and handle pattern is a bullish continuation pattern. It starts with a rounded bottom, the cup, followed by a short period of consolidation, the handle. When the price breaks above the handle, it often leads to a significant uptrend. Observing this pattern in relation to the exponential moving average can provide strong buy signals. Rectangles are another type of continuation pattern formed when the price moves between parallel support and resistance levels. The breakout direction from a rectangle often indicates the continuation of the previous trend. When combined with the exponential moving average, you can get a clearer signal of whether to buy or sell. By learning to recognize these chart patterns and understanding how they interact with the exponential moving average, you can make more informed and accurate trading decisions. Chart patterns provide the context, while the exponential moving average offers additional confirmation, making it easier to identify high probability trades. For example, a wedge pattern can often indicate a potential breakout. There are two types of wedges, rising and falling. A rising wedge occurs during an uptrend and suggests that the trend may soon reverse. If you see a rising wedge forming near the exponential moving average and the price starts to break below the exponential moving average, this is often a strong indicator of a bearish reversal. On the other hand, a falling wedge appears during a downtrend and signals a possible reversal to the upside. When a falling wedge forms and the price starts to break above the exponential moving average, it is a bullish sign that the trend might soon turn upwards. Triangles are another key pattern to understand. There are 3 types of triangles: ascending, descending, and symmetrical. An ascending triangle is typically bullish and forms when there is a resistance line above and an upward sloping trend line below. If the price breaks above the resistance line and moves past the exponential moving average, it is usually a strong buy signal. A descending triangle, which is bearish, forms when there is a support line below and a downward sloping trend line above. If the price breaks below the support line and drops below the exponential moving average, it can signal a continuation of the downtrend. Symmetrical triangles can be either bullish or bearish depending on the breakout direction. Watching how these patterns interact with the exponential moving average can help you anticipate where the market might head next. Another important pattern to be aware of is the cup and handle. This pattern is a bullish continuation pattern that looks like a teacup. The price forms a rounded bottom, the cup, and then moves sideways in a smaller consolidation, the handle. When the price breaks above the handle and moves past the exponential moving average, it signals that the uptrend is likely to continue. This pattern is often followed by a strong price increase, making it a great opportunity for entering a buy position. Rectangles are also worth noting. A rectangle forms when the price moves within a defined range, creating parallel support and resistance lines. This pattern suggests consolidation before a breakout. If the price breaks above the rectangle and is supported by the exponential moving average, it is a buy signal. If it breaks below and the price moves beneath the exponential moving average, it suggests a sell signal. Being able to recognize and understand these chart patterns and seeing how they relate to the exponential moving average will give you more context for what the market is doing. It will also help you be more confident in identifying when a trend is about to reverse or continue. Combining these patterns with the exponential moving average allows you to make more informed and strategic trading decisions. And guess what? Setting up the exponential moving average is not complicated. Most trading platforms make it really easy to do this. You just choose the time period, apply it to your price chart, and you will see that smooth line appear, giving you a clearer picture of what is going on with the trend. Once you have got your exponential moving average set up, the next thing you want to do is use it to identify trends. One way to do this is by looking at where the price is in relation to the exponential moving average. If the price is staying above the exponential moving average, it is often a sign of an uptrend. That is when you might want to consider buying or holding onto your positions. If the price stays below the exponential moving average, then you could be looking at a downtrend, which means it might be time to sell or hold off on buying. Now let me ask you a question. Have you ever felt unsure about when a trend is really shifting? The exponential moving average can help with that too. If the price crosses above the exponential moving average after it has been below for some time, that can be a signal that the trend is turning upwards. The opposite is true for when the price crosses below after being above the exponential moving average. These trend reversals are something you will want to watch closely. Another really useful technique is using exponential moving average crossovers to generate buy and sell signals. When a shorter-term exponential moving average, like the 12-day, crosses above a longer-term exponential moving average, like the 26-day, that is called a bullish crossover. It means the momentum might be shifting upward, and that could be a good opportunity to buy. This type of crossover is particularly important because it indicates that recent price movements are gaining strength compared to the longer trend. Bullish crossovers are often seen at the beginning of uptrends, and combining this pattern with increased trading volume can make the signal even more reliable. It is not uncommon to see traders use a confirmation strategy where they wait for a full candle to close above the crossover point to ensure that the momentum is indeed sustainable. On the other hand, when the shorter-term exponential moving average crosses below the longer-term one, it is called a bearish crossover. This suggests that the trend could be heading downwards, and it might be time to sell or stay away from buying for a while. Bearish crossovers often occur at the beginning of downtrends, signaling that recent price action is weakening. As with bullish crossovers, using additional indicators like the relative strength index or observing the trading volume can help confirm the validity of the signal. A popular approach to using crossovers is combining multiple exponential moving averages of different time frames, such as the 12-day, 26-day, and 50-day exponential moving averages. When the shorter moving average crosses above both the medium and longer moving averages, it is a strong indication of an uptrend. Conversely, when it crosses below both, it is a powerful signal of a downtrend. This approach is often called the triple crossover method and provides additional confirmation, which helps reduce the risk of false signals. Picture this. If the 12-day exponential moving average crosses above the 26-day, it means things could be heating up for the better. But if it crosses down below, it means the mood might be turning sour. These crossovers can be powerful signals if you know how to spot them and understand what they mean. Now let us look at another way you can use the exponential moving average, and that is as support and resistance. Imagine the exponential moving average as a kind of dynamic barrier. In an uptrend, the exponential moving average often acts as a support level. The price might drop down to the line, but then bounce back up. When this happens, traders often use it as an opportunity to buy or add to their positions. In a downtrend, the exponential moving average can act as resistance. This means that even if the price rises, it may get stuck around the line and then head back down. This is another signal that can be used to help make better trading decisions. For example, if you see a strong uptrend and the price bounces off the 50-day exponential moving average, that could give you more confidence to enter a buy position. The same thing works the other way around in a downtrend. If the price hits the exponential moving average but struggles to move above it, it is a sign that the trend might continue downwards. One great thing about the exponential moving average is that it can work even better when combined with other indicators. For instance, if you use it alongside the relative strength index, you can confirm your signals. Let us say you get a bullish crossover and the relative strength index shows oversold conditions. This is like getting 2 thumbs up that the price may be ready to rise. You can also pair the exponential moving average with the moving average convergence divergence indicator, also known as the MACD. The MACD is based on exponential moving averages and can help you see how strong a trend really is by highlighting momentum changes. When the MACD line crosses above the signal line and it coincides with a bullish exponential moving average crossover, it provides an even stronger signal that a new uptrend is beginning. Similarly, when the MACD line crosses below the signal line along with a bearish crossover of the exponential moving averages, it indicates that downward momentum is building. Another effective combination is to use the exponential moving average with Bollinger Bands. Bollinger Bands consist of a moving average with upper and lower bands set a certain number of standard deviations away. When price moves toward the lower band and simultaneously remains above a key exponential moving average, it may signal a potential buying opportunity. Conversely, if the price reaches the upper band and stays below a key exponential moving average, it may suggest a good point to sell or take profits. You can also use the exponential moving average alongside stochastic oscillators. A stochastic oscillator measures the current price relative to its price range over a specific period. When combined with the exponential moving average, you can filter out signals. For example, if the stochastic oscillator shows that the market is oversold and the price is also crossing above the exponential moving average, it can indicate a strong potential buy signal. Lastly, volume indicators play a significant role when used with the exponential moving average. Observing volume trends alongside the exponential moving average can provide further confirmation of the strength behind a price move. For instance, if you see a bullish crossover and there is a surge in volume, it adds credibility to the move, suggesting that the uptrend is more likely to sustain. If the crossover happens on low volume, it might be a sign of a weaker signal, and extra caution should be taken. Combining the exponential moving average with these various indicators allows you to build a more robust trading strategy. The more confirmation you have from different tools, the higher the probability of a successful trade, and the more confident you will feel in executing your trading decisions. And do not forget about volume. When you see a crossover happening, it is important to pay attention to the trading volume. Higher volume means that there is more strength behind the move, while lower volume could mean it is a false signal. Volume adds that extra layer of confidence to what you are seeing. The great thing about the exponential moving average is that it can be adapted to fit different trading styles. If you are a day trader, you might use shorter exponential moving averages like 5-day and 10-day exponential moving averages. These help you catch quick movements and make decisions faster. If you are a swing trader, using a 12-day or 26-day exponential moving average gives you more information to spot trends without being overwhelmed by every tiny price change. For long-term investors, the 50-day and 200-day exponential moving averages are key to keeping an eye on the big picture. No matter which style fits you, just remember that the exponential moving average is there to help you make sense of the bigger trend while staying aware of what is happening now. Now, as with any strategy, there are some mistakes that people often make when using the exponential moving average. One common mistake is relying only on the exponential moving average without considering other indicators. The exponential moving average is powerful, but it is best used alongside tools like the relative strength index, moving average convergence divergence, and chart patterns to confirm your signals. Another mistake is overreacting to every small crossover. Not every crossover is important. In sideways markets, a lot of small crossovers can happen, but they do not necessarily mean a big trend change. It is important to be patient and wait for signals that have more weight behind them, such as significant chart patterns like head and shoulders, double tops and bottoms, or triangles. For instance, if a bullish crossover occurs along with an ascending triangle breakout, this could be a stronger confirmation of an uptrend. It is also a mistake to ignore the larger market context. For example, a double top or a head and shoulders pattern forming near an exponential moving average can carry more significance than a simple crossover in isolation. By understanding these patterns and considering where they form relative to the exponential moving average, you can avoid false signals and focus on the more reliable ones. And here is another tip. Always use stop-loss orders. Even if the exponential moving average gives you a strong signal, things can still go the other way. Stop-loss orders help protect you and limit your risk, so you do not end up losing more than you can afford. Before jumping into live trading, it is a really good idea to practice using the exponential moving average on a demo account. This way, you can get comfortable with spotting crossovers, identifying chart patterns, using support and resistance, and fine-tuning your entry and exit points without risking your money. Make sure to practice recognizing key patterns such as head and shoulders, double tops and bottoms, wedges, triangles, and flags, all while observing how these patterns interact with the exponential moving average. It is also helpful to track your trades in a journal. This will let you analyze what worked, what did not work, and how you can improve. By documenting how chart patterns evolve and how well they align with the exponential moving average signals, you can better understand which setups are most effective and refine your overall trading strategy. Finally, do not be afraid to experiment with different time frames. Try using short-term, medium-term, and long-term exponential moving averages to see which ones work best for you. Every trader is different, and the only way to find out what works for you is by testing and practicing. To recap, the exponential moving average is a fantastic tool that helps you see trends more clearly, spot buy and sell opportunities, and use support and resistance levels effectively. The exponential moving average reacts quickly to price changes, which makes it especially useful for those who need timely signals. Start by adding exponential moving averages to your charts and try different time frames. Remember to confirm your trades with other indicators to increase your accuracy. The more you practice, the more confident you will be in using the exponential moving average to spot trends, make smart decisions, and improve your results. So keep practicing and refining your approach, and you will be on your way to better trades and stronger outcomes.